There's a wind of change sweeping through the U.S. financial market, and it's shaking things up. For the past year and a half, the Federal Reserve has been telling the market that they wanted to keep the rate higher for longer to bring down inflation. The market has largely ignored this message, betting that financial conditions would break under higher interest rates and that the Fed would be forced to cut rates sooner. Well, over the last 2 weeks, we've witnessed the U.S. Treasury market's first significant weekly net withdrawal in over 6 months. This sends a strong signal to the investment world that a shift has come. It seems the enduring higher for longer notion is finally starting to resonate with investors. As the market syncs with the Fed and starts the reality check, how might this alteration impact various aspects of our daily finances? From the interest on our homes to our credit cards, to how students finance their education, what does this notion of higher for longer impact our daily lives? And in the midst of all these evolving scenarios, Congress has introduced a temporary solution. We'll examine its contents and, more crucially, what's absent from it, and how it might trigger global market fluctuations. Before we start, take a moment to click on the subscribe button. Join the InvestGrowthWisdom community and stay updated with our analyses. Now, focusing on the current political landscape, the House of Representatives, often reminiscent of a spirited debate club, has endorsed what's termed a Continuing Resolution, CR. This is essentially a temporary funding bill that ensures the government remains operational for an additional 45 days. After which, the drama restarts. So, after all the political tug-of-war and the last-minute closed-door discussion, do we just get to kick the can down the road? Well, we also got this photo of Representative Jamal Bowman's fire alarm incident. I mean, seriously, what exactly does this CR contain? Although we're not sure exactly what's included, a clear omission is the lack of support for Ukraine at the moment. But the push and pull for Ukrainian aid among the political elite remains strong. Key leaders, like the former Republican House Speaker, the Democratic Senate leader, and the U.S. President, are all voicing support for substantial aid to Ukraine. This move to fund their war operations is a heavy financial undertaking, one that goes against the grain of the Federal Reserve's fiscal tightening approach. With the U.S. military expenditure inching closer to a staggering $1 trillion yearly, funded through loans, we're observing a trend of lavish fiscal indulgence. Just think about it, a proposed budget of $6.9 trillion simply to keep the government operational. This doesn't cater to any emergency needs such as natural disasters or wars. This $6.9 trillion is a staggering 44% of our annual GDP. In the past, we only saw this level of spending 3 times in history during major crises: World War II, the Great Financial Crisis, and the recent COVID pandemic. Yet, here we are, and what really bothers me is it seems this could continue to be the new normal of fiscal spending for the future. Back in 2019, the Trump administration's budget was $1.3 trillion, and everyone thought it was over the roof then. After the pandemic hit, now we're discussing the notion of $6.9 trillion. It paints a clear picture of long-term fiscal inflation. The aftermath of this financial decision has set off a series of domino effects. With the U.S. national debt crossing $33 trillion, it's important to spotlight an intriguing pattern. Over the past 6 months, there's been a consistent inflow into U.S. Treasuries, marking the most extended influx sequence recorded. But even this demand hasn't been enough to stop yields from rising. Post the recent press meet by the Federal Reserve's chair, Jerome Powell, the sentiment amongst bond traders and investors has transformed. Those bullish on U.S. Treasuries appear to be recalibrating their strategies. There's a whisper network suggesting the Federal Reserve is doubling down on its higher for longer agenda. Bloomberg recently has a report titled, "Once Unthinkable Bond Yields Now the New Normal for Markets," they write. It was the week that bond markets finally seemed to grasp what central bankers have been warning all year: higher interest rates are here to stay. From the US to Germany to Japan, yields that were almost unthinkable at the start of 2023 are now within reach. The sell-off has been so extreme it's forced bullish investors to capitulate and Wall Street banks to tear up their forecasts. In the past, their campaigns noticeably affected market sentiment, but Jerome Powell's impact seems more muted. Yields on 10-year German debt are close to 3%, a level not reached since 2011. Their U.S. equivalent are back in line with the average from before the global financial crisis and within striking distance of 5%. To put it simply, the jump beyond 5% isn't just about numbers. It marks a significant shift in the financial landscape. The question now is how much higher they can go, with no real top in sight after key levels were broken. While some argue the moves have already gone too far, others are calling it the new normal, a return to the world that prevailed before the era of central bank easy money distorted markets with trillions of dollars of bond buying. The implications stretch far beyond markets to the rates paid on mortgages, student loans, and credit cards, and to the growth of the global economy itself. Bill Ackman, a notable name in the finance world, shares his insights. His prediction? A world that's structurally evolved. He underscores rising national debts, lack of fiscal discipline, and the constant teetering on the brink of defaults. 2 months ago, he announced he's betting against long-term Treasury bills. He predicted the 30-year rate would reach 5.5% sooner than expected. While it's not there yet, it's nearing that mark. Furthermore, if the 10-year surpasses 5%, the aforementioned might follow soon. Check out his recent post on X from September 21 discussing this. I believe that long-term rates, the 30-year rates, will rise further from here. As such, we remain short bonds through the ownership of swaptions. The world is a structurally different place than it was. The peace dividend is no more. The long-term deflationary effects of outsourcing production to China are no more. Workers' and unions' bargaining power continues to rise. Strikes abound, with more likely to come as successful walkouts achieve substantial wage gains. Our national debt is $33 trillion and rising rapidly. There is no sign of fiscal discipline by either party or by the presumptive presidential nominees. And each debt ceiling is an opportunity for our divided government and its most extreme actors to get media attention and for our nation to threaten default. This is not a good way to recruit the many new buyers we need for our bonds. I bumped into the CIO of one of the world's largest fixed-income asset managers the other night and asked him how it was going. He looked like he had had a tough day. He greeted me by saying, "There are just too many bonds, a veritable tsunami of new issuance each week." I asked him what he was going to do about it. He said, "The only thing you can do is step away." This reflects the broader issue, a growing bond supply but not enough buyers, especially for government debt and mortgage-backed securities. It's quite perplexing how interest rates remain so subdued. Adding fuel to the fire, China has switched gears, becoming a net offloader of U.S. debt. The signs are on the wall, brace for ascending rates. Bill Ackman seems to be in sync with this notion. He states, "I have been surprised at how low long-term rates are. I think the best explanation is that bond investors thought of 4% as a high rate of interest because rates hadn't breached 4% for nearly 15 years. When investors saw the opportunity to lock in 4% for 30 years, they grabbed it as a once-in-their-career opportunity, but today's world is very different from the one they have experienced up until now. The long-term inflation rate plus the real rate of interest plus term premium suggests that 5.5% is an appropriate yield for 30-year treasuries. And query whether 0.5% is a sufficient real long-term rate in an increasingly risky world." That statement was dated September 21. Fast forward, with significant bond markets selling last week and the added debt our government committed to, brace yourselves for higher interest rates in the near future. Thank you for joining us on this deep dive. If you found this analysis valuable, show your support with a like. And for more insights, remember to subscribe to InvestGrowthWisdom.